Um, so this question comes in from Oliver, again on Lakeland Industries, LAKE on the NASDAQ, currently trading at a price of about $13.45. I think it actually closed today at $14. Market cap of about 122 million and a dividend yield of just under 1% at 0.94%. So they manufacture and sell industrial protective clothing and accessories for the industrial and public protective clothing market worldwide. It offers firefighting and heat protective apparel, high-end chemical protective suits, and limited use disposable protective clothing, as well as high visibility clothing as well. The company targets a mid-single digit organic growth rate across the business and also makes acquisitions with 5 over the past 3 years, trying to roll up the fragmented global fire market now with a head-to-toe product offering. We have interviewed management a few times now, the most recent being in April of 2025 at the Planet Microcap conference in Vegas, but the stock has really been struggling this year so far, down 50% year to date. And this has really been led by Trump's Liberation Day tariffs, as the company either leases or owns manufacturing facilities in the US, but also in China, Mexico, Argentina, India, Vietnam, Romania, and New Zealand. And management noted back in April that they had built up inventory with about 10 to 12 months of runway before a major impact. They also moved some production into the US, as well as shifted critical component sourcing from China to Vietnam, and that they expect to increase prices of its products to offset potential margin impacts as well. So they are trying to mitigate the effects of tariffs. Now, looking at the financial results for Q1 of 2026 ended April 30th of 2025, revenue was up 29% to 46.7 million. And this was led by growth in its fire services product line due to the acquisition of Veridian, acquired in December 2024, and LHD, acquired in July of 2024. Gross profit margin was 33.5% compared to 44.6% for the same period last year. And the lower gross margin is due to revenue mix coupled with lower margins in its acquired businesses due to amortization of the write-up in inventory, as well as higher manufacturing and freight costs. The company posted an operating loss of 4.6 million due to a significant increase in operating expenses attributable to the acquisitions of Veridian and LHD, and net loss was 3.9 million, or a loss of 41 cents per share, compared to a gain of 1.7 million or 22 cents per share in Q1 of 2025. And the company posted adjusted EBITDA, excluding FX changes, of just $600,000, down from about 3.8 million for the same period last year. So, margin wise, it was a bit of a tougher quarter, but top line growth was still strong, driven by the acquisitions. Now, the balance sheet remains relatively healthy with net debt of 21.6 million, providing a forward net debt to EBITDA multiple of just 0.8 times. And the company has also been pretty good at reducing its share count over the years, but they did issue 1.8 million shares back in January of 2025 at a price of $23 per share, which now places the company at approximately 9.5 million shares outstanding. So obviously, moving forward, it will be interesting to watch to see if they use their shares as currency more, especially as they are this roll up growth strategy. So that is something to keep an eye on. Now, looking toward fiscal year 2026, management provided guidance, and they expect revenue of 210 to 220 million, which represents growth of approximately 29% over fiscal year 2025. And this includes the Veridian acquisition. And adjusted EBITDA is now expected to be in the lower end of its $24 to $29 million range due to tariffs, but at the midpoint represents growth of approximately 52% over fiscal year 2025. And looking at the valuation, this places the company at approximately 5.3 times forward adjusted EBITDA, but its trailing valuations are all negative, such as its price to cash flow or price to earnings multiple, just because cash flow and earnings have been negative over the last 12 trailing months. So to conclude here, Lakeland is an intriguing recessionary resistant business. It's not recession proof, but it's recessionary resistant with mid single digit organic growth, while it plans to continue rolling up the fire market with up to 2 acquisitions a year. So we definitely see it having some good runway in that space. Now, the business is currently facing some tariff headwinds, but management has put in place plans to mitigate tariffs and continues to guide fiscal year 2026 revenue and adjusted EBITDA growth of 29% and 52% respectively. Again, partially driven by those acquisitions that it has made. The company does pay a dividend, but management noted that they would prefer that they didn't have it and do not expect to grow it. That is one thing that kind of attracts me to a business like this, is the dividend. It's kind of a boring business. But if they could grow that dividend over time, I think that would be quite intriguing. But I understand management's strategy, where again they are this roll-up strategy. They want to continue to use their capital for acquisitions and create shareholder value that way, rather than just returning capital to shareholders through the dividend. So I understand the strategy, but I do think that it would be interesting if they wanted to grow that over time. And just overall, growth does remain good this year. The business appears cheap on forward adjusted EBITDA, but tariffs remain a risk. Q1 2026 was weaker, but there should be sequential improvement in margins as the year goes on, which we will continue to monitor going forward. And here is the disclosure.
I remember interviewing this company in Vegas with you guys about a year ago, and we had looked at it. We'd been following it for almost a year at that point, and it just really seemed like a very simple kind of what could go wrong with this business, right? I mean, it had good profitability. It seemed to be selling into what would you'd consider to be an essential industry, right? But now maybe there could be something to follow in terms of just valuation wise, if they can get back up to that level of earnings. But I certainly wasn't expecting this type of volatility in the performance. Of course, they weren't expecting Trump's tariffs either. So a year ago.
For sure.
But yeah, I agree. Or go on, Ryan.
Yeah, I was gonna say, I guess the with Lakeland, they want to be creative. They want to grow that way, roll up its segment. I think the rubber is gonna hit the road. It's been a good, disciplined, long-term company, not issuing a ton of shares.
Yep.
Now they're in a net debt position, so they're starting to issue shares. It was done at higher price earlier this year, so it's more easy to be accretive, but now in a net debt position, lower share price, it's more difficult to make accretive acquisitions on a per share basis. So I mean, we've seen companies get into that situation where they can't get a multiple for their shares. And then, you don't want to issue shares because then it's not accretive on a per share basis, and it's a vicious cycle. So again, like what I was talking about earlier, is the patient approach is typically better than if you can't make those acquisitions, they're not smartly accretive. Generate cash flow, pay down some debt, and then either do it when you can or do it slower. It's just, we see so many companies so desperate for the next quarter. Matt, there's analysts out there, they're always, oh, are you growing? Why aren't you growing? Well, if you grow irresponsibly, it's far worse in the long term than just growing for the sake of revenue and not on an accretive basis in terms of per share cash flow will not drive your share price higher long term. So, I mean, this hopefully Lakeland, takes that advice basically and grow at a measured pace. If you can do it accretively, 2 acquisitions a year, fine. If you can't, either you go too much into debt or you can't issue shares, just pay down debt, then make your acquisitions over time. That would be the way to do it. I mean, we just saw Fearon, a boring business, do that. And, those are I'm sure Lakeland would love to produce 700+% growth over the next decade. So there's your path, measured and disciplined, and make sure you keep that share count lower.